All right, welcome to the Hit It Monkey Daily Update. It's Thursday. It was an awesome day today as far as trading wise goes. Volatility was up, and its market's been doing great as far as what we want as premium sellers. So this may be a two-part video too because I wanted to do a real quick review for new people who are new to the forum and maybe new to options. And for those of you who are more advanced, maybe I lost you as a member or whatever because I'm really doing this for the new guys because once you get the basics down, you can pretty much do everything. And to be frank, these will give all those other fancy traders a run for their money. As you can see, the stuff I talk about, sometimes I'm even earlier talking about it than what you see on Tasty Trade or wherever, just what I'm looking at. But so I'm going to review a couple things as far as what the forum is all about and basically I guess your go-to trade. I mean, this is your baseline, meaning the bar is set here. You need to check your returns on based on these because the strategies are just been proven. Okay, so I had a earlier question today on the basics of the trade, and I just kind of mimicked this on a smaller scale and Karen the Super Trader does, and just try to apply it to any type of volatility type of situation or any market conditions. And sometimes not making a trade is better than making a trade just to trade. So if you go to whoops, how do I go back there? Oh, okay, I'm sorry. Let's go to the question. The gist of my basic trade is my cheat sheet. So if you go here under Golden Gecko, and you'll see it here, but the updated one is right here, the Super Trader style pin. So this is the gist of the trading and everything gets adjusted from here. Basically, all a Golden Gecko is a synthetic naked triangle. But I like this because even if I had more capital, I like the idea of saving my capital so I can put on more trades. So you can read this, but basically it's 45 to 56 days expiration. You want to sell IB rank if IB rank is greater than 50% if it's a stock, greater than 35% of ETF, and you want to collect 19.8% of the expected move. I'll go over that in a second. At the same time, so you're going to sell the one standard deviation out of the money put and call strikes, which means you have an 84 chance of being out the money on both sides. Then you're going to buy the further out of the money two standard deviation puts and strikes. Now here you can place a good to cancel order where you want to buy it back where it gets to 50% of max profit. And you can also put a good to cancel order where you buy it back if it gets to double what you received in buying back basically for the credit received, and I'll go over that in a minute. Okay, but you can read this. It's under that Golden Gecko, this Golden Gecko thread, and it's called My Golden Gecko Super Trader Style. Now, if you have a smaller account, what you can do is do this when you go to Dole, and you know what? I'll just explain this right here. It's just a lot easier. So let me go to Dole, all right, and I'll go to Trade Page. And I usually do it on the SPY. So here's the SPY already as it is. And what you can do here is these are all the positions. I'll try to zoom in one click real quick. Right, so these are the positions I have on now in the SPY. SPY is 49%, so it's pretty much about 50. Okay, and here's how I set up the Golden Gecko. I go to Choose Strategy. All right. And I go to Iron Condor, and these should be your settings under Iron Condor. Okay, the star should be here because it's going to be your default one. You want to set this to 56 days out, or 45 days is what Tasty Trade uses. Karen goes off 56 days expiration and she churns it, meaning she'll sell she'll put position on and off within that time frame. One standard deviation is 84% out of the money, and you know what? Set this to 5, and I'll show you why in a minute. But if you don't have as much capital, 5 with strikes have been proven to be very good for selling these Golden Geckos and bringing the wings in further because it's better for your return on capital. It's been really proven to be great for return on capital. That will be on the forum here. Somebody asked a great question about that actually, and it was, I think, yesterday, or was it yesterday? Here it is. I'm sorry, go to page 96. If you go to page 96, it's right. Oh man, I don't know. Was it 90? Oh man, I'm sorry. I don't know why I can't find it after I do this stuff. So let's go to 95. Wow, I just put it on there. I don't know what happened. Anyway, there was a market measure that covered that stuff. So, and I'll find it again. Those are the stops for. Oh man, I apologize. Oh, by the way, sorry. It's on page 97. Efficiency market measure. You can click on that market measure for making your widths five strikes apart. Okay, so I'll go back to this. I apologize. Now, so all a golden gecko is. So when I say the width are $5 apart, meaning look, 183 minus 5 is 178. 206 minus I'm sorry, 206 plus 5 is 211. So you want the width from here to here to be five strikes apart. So this is kind of like a mini golden gecko, okay? But a standard golden gecko is when your wings are out to the 2 standard deviation line, okay? So when you check over here where it says 1 standard deviation, it'll automatically always go to that 1 standard deviation line, which is, see this blue dotted line right here? That's the 1 standard deviation line. The other one is right here. Here's a 2 standard deviation line, this vertical line right here. So you want to move these out, so where the point is right about there. Okay, so you will see I can collect now $1.16 credit, and it's the probability of profit is, so the probability of me not losing money or me making a penny is 71%. Now, how do you know if you're collecting enough? Well, if your ETF is 35% or greater, you want to collect at least 19.8% of the expected move. How do you do that? How do you figure that out? Okay, for that, I'll clear this to show you again. You're going to go to Choose Strategy. You're going to click on Strangle this time. Same 45 days, 84 days, right? And then hit Go. Okay, and then you're going to look at how much you can collect. So we can collect $1.59. So we're selling something. So someone has to pay us $1.59 for this position. How do we know if that's enough? You just click on Thinkorswim. You enter SPY. You go to your trade page, which is right about there. Okay, and from here, all you do is you look up the same days expiration. So over here, you see how we have 50 days expiration, November 22nd, 2014 expiration. Okay, you're going to go to Thinkorswim. You're going to find that same 50 days expiration. You're going to open that up. If it looks like this, just open it up. See, it should be right here where it says the 100 ones are the standard ones. That means one contract is 100 shares. Click that open and then drag along and look what it says right here. It says 9.463. That is the expected move up or down in dollars of what the S&P, the SPY, the expected move of the SPY over the next 50 days. Okay, so you take 9.462 and you want to multiply that by 19.8%. Okay, so you take this number right here, 9.462. Oops. Take your 9.462. Go to your calculator, multiply that by 0.198 for 19.8%. Okay, then you hit enter, and I want to be able to collect at least $1.87. As you can see, that's not enough. So does that mean you don't trade it? No, it doesn't mean you don't trade it. Remember now, the 19.8% was a criteria if a stock was at least 35% or greater, IB rank. Okay, because it's a lot higher than 35% IB rank, you can settle for less because remember now we're selling volatility, so you're betting that the vol will collapse. Okay, so assuming this was the same enough, right? All you do from there is this is called a naked strangle. Strangle, you meaning you're not buying out the wings. What do I mean by buying out the wings? Well, here's that 2 standard deviation line. See this normal bell curve here? The reason why they call it a iron condor or a strangle is it looks like a bird. This is the body of the bird, and out here looks like the wings, right? Out here looks like the wings. So if someone tells you you're buying the wings, you're buying the wings. You want to place a position out here. So watch. Go to Choose Strategy. I go to Iron Condor. let the bird, click go, and here's the wings. So you want to move the wings out to the 2 standard deviation line, which is right, that blue vertical line right there. Whoops. You know, as close as you can to it. Okay? And you're buying the wings. Okay, so you can collect $1.16. All right, and if you want to look again, and then you just hit review and send and place your order. I don't. So you can see I have multiple positions on. I was been putting on positions as you know as volatility rises. If you want to know you're probably out of the money expectations, click on this leg right here icon, and it'll show you. See, so you know 1 standard deviation, which is this first 2 blue lines right here. You want to get that as close to 84% as possible. You want to get the buy side closer to the 2 standard deviation line. So why did I tell you put the widths at $5 apart? Well, take a look. I'm risking $1,184 to make $116. So pretty much that'll be like a 10% return on my capital, right? But what if you don't have a larger account? You don't want to risk this much or tie up this much capital. Okay, so watch what happens when actually I think I can click the back button right here. Oops. I think I can click this back button right here and it'll go back to the $5 wide ones. Oops. There we go. Okay, now all of a sudden look what happens. Okay, my probability of profit is still roughly the same. I collect less. Okay, let me show you again real quick. Go to with default. Here we go. Right, look. Okay, so remember this. I can collect 69 cents now, but now look, I'm only risking $431 to make $69. Okay, $5 wides apart. If I move this back out, remember that now. 400 what? 431. So if I collect this full amount, that's more than what? 10% is $43. That's way more than a 10% return on not quite 80. I mean not quite 20%, but you see what I'm getting at. Now let's move the wings. Let's move the buy sides back out to the wings and buy it further out. Remember that 2 standard deviation line? I collect more. My probability of profit only went up 2%. Okay, but I'm risking more than double the money. Okay, that's why I said when you go to choose strategy, go ahead, make it, especially if you're beginning, make this default to 5. Okay, and you can go from there. And on my forum again, I listed why efficiency on the forum. If you go further down, I listed why that might be better. Okay, and it's on that one is on page 96 for sure. Right here. I forgot. I don't know. It's on here. It's called efficiency. If not, I'll post it again. But I don't want to waste too much time looking for it. I put a link somewhere. Anyway, on that. Okay. So that's great for new members. Now I wanted to go over. Let's go over the markets. The market a little bit. So here's the charts we covered yesterday. If you remember, we did this yesterday. Oh, you know what? I only have a couple minutes left, so I'd rather just show you where those links are for those market measures, and I'll do a part 2 for a market update. Okay, go to it's under Golden Gecko because all the important market measures I put that I think are really good for the Golden Gecko are here. It will be under your favorite slides as well. But I have everything here. What you need, the videos, the game changer video, how much premium to collect. You know what I mean? And then in the market measure thread right down here, most applicable market measures down there. It should be here, efficiency defined risk. This is the one. If you click on this, it'll show you why about 5. This chart right here. It's the last here. The reason why here's the width 5 widths apart because marginal cost is not higher than your increase in probability of profit. So that's why 5 strikes have been shown to be very efficient when doing these defined risks, and you still get, a great return on capital. Okay, I'm pretty much out of time, so I will wrap this up, post this, and I'll come back with part 2 with regards to what happened in the markets and what I think. All right, thanks.